Over the past 4 years, the United States has faced a series of economic challenges culminating in significant cumulative inflation. From January 2021 to May 2024, United States inflation has shown a worrying upward trend, impacting not only the domestic market but also reverberating in economies around the world. This rise in inflation can be attributed to a combination of factors, including a low-interest monetary policy maintained for over a decade and the devastating economic effects of the COVID-19 pandemic. Since the 2008 financial crisis, the U.S. Federal Reserve has adopted a low-interest policy, keeping interest rates near zero to stimulate the economy. This strategy was implemented to encourage borrowing and spending, promoting economic recovery after the recession. For more than a decade, low interest rates have helped sustain economic growth, increase employment, and stimulate investment. However, maintaining low interest rates for an extended period has also brought unintended consequences. One of the main effects was the appreciation of assets such as real estate and stocks, creating a sense of wealth among investors but also increasing the risk of financial bubbles. Additionally, with the artificially low cost of capital, companies and individuals took on more debt, increasing economic vulnerability to unforeseen shocks. The COVID-19 pandemic, which began in late 2019 and spread rapidly in 2020, caused an unprecedented health and economic crisis. In the United States, lockdown measures, business closures, and supply chain disruptions resulted in severe economic contraction. Millions of Americans lost their jobs, and the federal government responded with massive stimulus packages to sustain the economy. The stimulus packages, although necessary to mitigate the crisis's impacts, injected trillions of dollars into the economy, increasing the money supply. With the gradual reopening of the economy in 2021, demand for goods and services rose rapidly, while supply still faced constraints due to global supply chain issues. This discrepancy between supply and demand was one of the main drivers of inflation. U.S. inflation data for the past 4 years illustrates the severity of the problem. 4% in 2020, 7% in 2021, 6.5% in 2022, 3.4% in 2023, and 3.4% up to May 2024, totaling approximately 21%. These numbers indicate a substantial increase in inflation starting in 2021, reflecting both the effects of previous monetary policy and the economic repercussions of the pandemic. Contributing factors include expansionary monetary policy. The Fed's decision to maintain low interest rates and continue asset purchase programs contributed to increased market liquidity. Fiscal stimulus. Stimulus packages, including direct checks to citizens and support for businesses, increased aggregate demand. Supply chain disruptions. The pandemic caused production and distribution bottlenecks, consequently raising costs. Rising energy prices. Geopolitical events, such as the war in Ukraine, impacted oil and gas prices, increasing transportation and production costs. Inflation has eroded the purchasing power of American consumers. Basic products, such as food and fuel, have become significantly more expensive. Low and middle-income families have been the most affected, as a larger proportion of their income is spent on essential goods. In the real estate market, property prices have soared, making it more difficult for new buyers to enter the market. Although low interest rates initially facilitated home purchases, subsequent inflation and rising interest rates in response to inflation have made it harder to obtain affordable mortgages. Inflation has also impacted savings, reducing the real value of bank deposits. Investors have sought assets that offer protection against inflation, such as gold and cryptocurrencies, increasing the volatility of these markets. Globally, U.S. inflation has had repercussions due to the interconnectedness of world economies. Rising prices in the U.S. have increased import costs for other countries, especially those dependent on American goods and services. Despite domestic inflation, the U.S. dollar has remained strong relative to many other currencies. This is partly due to global confidence in the U.S. economy and the perception of the dollar as a safe haven. However, a strong dollar can hurt American exports, making products more expensive for foreign buyers. Developing countries have faced additional challenges, with U.S. inflation and the subsequent Fed response of raising interest rates. There has been a capital flow back to the United States destabilizing emerging economies that rely on foreign investments. The Federal Reserve has begun gradually increasing interest rates to curb inflation. This policy shift aims to reduce aggregate demand and control price escalation. However, there is a risk that rapid rate hikes could slow the economy and potentially lead to a recession. The federal government may also adopt fiscal measures to mitigate the effects of inflation, such as reducing taxes on essential goods or offering subsidies to vulnerable groups. However, such measures must be balanced to avoid exacerbating inflation further. Investing in supply chain resilience is crucial to prevent future bottlenecks. Encouraging domestic production and diversifying import sources are important strategies to reduce dependence on external suppliers. The cumulative inflation in the United States over the past 4 years is the result of a complex combination of prolonged economic policies and unexpected shocks, such as the COVID-19 pandemic. The decade of low interest rates created an economic environment that, although initially beneficial, increased the vulnerability to crises. The pandemic exacerbated these vulnerabilities, leading to a significant increase in prices. The impacts of this inflation are widely felt by American citizens, who face a higher cost of living, and reverberate around the world, affecting interconnected economies. Addressing these challenges requires a balanced approach that includes adjustments in monetary and fiscal policies and a focus on supply chain resilience. Only through coordinated and careful actions will it be possible to mitigate the effects of inflation and promote sustainable economic recovery. Currently nearing the American elections, the high inflation and its economic consequences are central themes in the 2024 election campaigns. Voters are concerned about the cost of living and economic stability, and this is reflected in the candidates' priorities. The results of the 2024 elections may be significantly influenced by voters' perceptions of the candidates' ability to manage the economy and control inflation. The inflationary pressure of recent years has been a test for the country's economic leadership, and the political decisions made now will have long-term repercussions.